Infrastructure investments have long been recognized as a foundation for economic growth, and low-carbon infrastructure is increasingly becoming an area of interest for investors in both public and private markets. But how will low-carbon infrastructure play a role in the evolving energy investing landscape?
Infrastructure is the physical backbone of any part of the economy. It's transport, it's power, it's water, it's waste, it's digital assets, it's everywhere. And it's absolutely key to growth in what is a relatively low-growth environment.
Welcome to The Bit, where we break down what's happening in the markets and explore the forces changing the economy and finance. I'm Oscar Polito. Coming up, Helen Jewell, Chief Investment Officer for Fundamental Equities at BlackRock, will help me explore the significance of infrastructure from an investing perspective, the opportunities in public markets, and the long-term growth potential from investments in renewable energy. Helen will also provide insights into how infrastructure can facilitate the decarbonization of power generation and the challenges investors should consider in this dynamic investing trend. Helen, thank you so much for joining us on The Bit.
It's great to be here.
Helen, we are here to talk about infrastructure, which is a topic that we've been talking about for a while now. We've had Jay Jacobs talk about the infrastructure development that is needed in the U.S. We've also heard from others about the build-out of data centers that are needed for the growing use of AI. But perhaps you could give us a reminder of its significance from an investing perspective. And also, how does it tie to this theme of low-carbon investing?
Well, Oscar, the key thing to remember is that infrastructure is the physical backbone of any part of the economy. It's transport, it's power, it's water, it's waste, it's digital assets, it's everywhere. And it's absolutely key to growth in what is a relatively low-growth environment. What's important is that when we have quite high public debt levels, we need to have private capital coming in to really make a difference in infra. And infrastructure is critical to addressing the world's expanding energy needs. I know a lot of people have talked about this already, but historically, Europe's energy need was decreasing and the US was flat. But that is now changing. Global electricity demand is forecast to grow by around 4% a year between now and 2027. And in the US, that means adding the equivalent of California's current power consumption to the national total over the next 3 years. Now, that is driven by a number of things. And the one that most people talk about is, of course, AI. But one of the most major sources of need for energy in the future is also things like air conditioning. So it's not just about AI, it's about so many of the things in the day-to-day. And a mix of energy is really, really important to meet that demand. You need not only the traditional energy sources, but you need low carbon sources to be coming through. And that requires ultimately a lot of infrastructure spend.
Helen, you mentioned infrastructure is all around us. It's a fundamental part of any economy. And you also mentioned that private markets play an important role in funding the growth of infrastructure. And that's, I guess, how I think about it, because I think these tend to be longer dated projects and they require capital that maybe needs to be locked up for many years. But how do public markets offer access to the infrastructure theme?
Yeah, it's a great question, because I think when people think about infrastructure, they often do think about the private market piece. But key infrastructure assets include electric transmission, distribution lines, toll roads, railroads, airports, power plants, pipelines, cell towers, data centers, utility companies. It's like you say, infrastructure is literally all around. And all of these companies can actually be accessed by public markets. So, for example, just to throw a couple of examples out there, cable makers such as Prysmian are essential for power grid upgrades. And other grid service providers such as Hubble, they are found in public markets. Public markets are also home to many of the materials and energy companies that are essential to infrastructure expansion. So what you actually find is much of the infrastructure need is found in public markets.
And so, Helen, what are some of the reasons that investors might want to use public markets over private markets to access this theme? Or do you see value to both public and private markets as a way to invest in infrastructure?
There's definitely value in both. But let me give you 4 reasons why we think that public markets are a really interesting place to play the infrastructure theme. Liquidity, diversification, income, and valuations. So let's start with liquidity. Ultimately, public markets are liquid and private markets are not. The second of these is diversification. What a lot of people don't realise is there's not a large overlap between infrastructure and global equities. For example, the MSCI World or the S&P 500 contain just 3% infra. So by increasing your exposure to the asset class, you offer a natural diversification to your portfolios. And what we've also seen is that infra stocks historically outperform when broader markets fall. Companies like utilities also give you income. And income is a really, really important part of the infrastructure story. You've seen dividends of around 3% within this space. And the final part is valuations. Infrastructure stocks remain at a discount versus the broader equity market, especially those companies in the renewable energy space, because a lot of the news flow around that space is putting pressure on the valuations. But we believe that this presents a really attractive entry point for investors who are interested in listed infrastructure names. The discount has already been noticed by private buyers who are recognizing both the long-term earnings potential of listed infra companies and their low valuations. And we're expecting and already seeing listed infrastructure M&A activity to be a part of the valuation story as well, and providing us with a floor for those valuations. Just recently, for example, we saw private equity company Brookfield buy the US renewable energy assets from National Grid. So 4 really, really important reasons why public equities are such an important part of infrastructure spend: liquidity, diversification, income, and valuation.
Helen, that was super clear, those 4 reasons. And the valuation point, I can't help but think that with public markets, the price is invisible in the market every day, right? That's the point of public markets. You see valuation instantaneously. And
we sure do.
yeah, you don't see that with private markets as well. That goes to your point of liquidity. Liquidity is different, and sometimes private market valuations are a bit lagged, but the valuation point is instantaneous and noticeable to the buyer and the seller for that matter. Helen, let's talk about low carbon infrastructure. How does the low carbon landscape intersect with the infrastructure theme that you're talking about?
Well, it's all about the investment. I think the starting point of so much of this is to remember what those energy needs really are. And investment in the low carbon energy transition has grown 11% to hit $2.1 trillion in 2024. You need power, and that power generation comes from all different sources. And again, it's not just those companies which are providing the initial power. You need the companies that are supplying the grid-related connections, cables and equipment, transformers, power management. That is all part of the jigsaw puzzle. So investment in power grids totaled around $400 billion in 2024. And whilst renewable companies can be accessed in private markets, when it comes to these grid-related names, they are mostly accessed by public markets. And we all know, and it's been talked about so much on the bid as well, the AI demand pull that is coming over the next few years for energy. But right now, what we are really focused on is grid hardening, making these grids more resilient, especially as climate-related disasters are becoming more common. We want wires to be below ground to reduce the risk of fires. So the expansion of this grid infrastructure is absolutely pivotal to the low carbon transition, and enormous investment is needed to boost the ability to get that energy from where it is made, maybe a remote wind farm miles away, to where it's actually being used in towns and cities. I mean, just take National Grid. National Grid own the electricity transmission system in England and Wales. And these kind of utilities are the ones that are critical to making sure that the sources of power generation are able to get to where that power is being used. And National Grid has outlined enormous levels of investment and aims to double the amount of energy that can be transported around the UK. So it all goes back to that stat. We need 4% more energy, and this comes from renewable energy, as well as hydrocarbons, and it all needs to go to where it is needed. And these grids that are pretty much exclusively in the public markets.
Helen, the more I listen to you, it's clear that infrastructure is a very pervasive theme. It cuts across private markets and, as you've made the case, public markets as well, and numerous sectors, and for that matter, numerous geographies. Part of what you've talked about is the utilities sector. So maybe talk a little bit more about how utilities facilitate the decarbonization of power generation, and maybe talk more about the long-term earnings growth from investments in renewable energy.
Oh, Oscar, I just love utility companies. And utility companies are often overlooked in the ongoing overhaul of the world's energy system, even though they comprise around half of the listed infrastructure universe. They give you also resilience in portfolios. Some of them are pretty monopolistic in nature, meaning very high barriers to entry. And so what they have is these cash flows that are viable, visible, long-term, contractual, really, really powerful cash flows. And the sector's investment in renewable energy may result in significant long-term earnings growth. They could cross a 50% share of electricity generation at the end of the decade through renewables. The electrification of various fossil fuel-powered processes, oil drilling, oil driving, is also supportive of electric utility growth. And the drive to a low-carbon economy has brought support from the regulatory space as well. Governments, consumers are all leaning into the investment that is needed by the utilities to support the energy need. Utilities, they are part of the solution for this.
It is interesting because when I think about the utility sector historically, it does feel like a little bit of a, I'm going to use the word boring sector, but boring is not a bad thing. There, as you mentioned, consistent cash flows, they operate in high barriers to entry. And now it sounds like it's a sector that is benefiting from the demand for AI, the infrastructure theme, and so perhaps a sector that is going through a little bit of a renaissance.
Yeah, it really is going through a renaissance. I think when people think about boring, they're missing what exactly you say, what boring means. It means resilience. It means consistency of cash flows. And a lot of the time, what people are focused on is, again, they're thinking, okay, well, maybe the regulators will start to back away from things like renewables. But again, what it's missing is the need for renewables to be part of the energy solution that we have. So why wouldn't you want these assets that give you a steady source of cash flow with potential earnings uplifts as well? They're in the perfect place to be. And again, what we're seeing at the moment is a lot of the valuations are being compressed because of externalities that are not really relevant and important to the actual fundamentals of these businesses.
Helen, we have talked to some of your colleagues at BlackRock, folks like Olivia Markham, who last year talked about the materials that would be needed to electrify the power grid.
So in very simple terms, materials are the building block of electrification and the energy transition. We need substantially more materials in the future than what we use today. Bloomberg New Energy Finance estimates $2.1 trillion to be invested into energy metals between now and 2050.
We've also talked to Will Su about the demand for energy that is going to be created from the growing use of AI and the power demand that brings.
Energy demand has grown by about 1.6% per year globally. That might seem really, really small, but thanks to the magic of compounding, the world today uses 32 times more energy than we did 2 centuries ago. And we expect that demand to continue to grow because energy is just so foundational to human progress and quality of living. So by the year 2050, most forecasts are calling for another 15% or more of energy demand growth going forward. And a lot of that, of course, will come in the form of electrification and more electricity generation.
How is the demand for materials and metals expected to increase due to investments in AI data centers and renewable power? And what challenges does the supply side face? In other words, is it easy to get these materials and metals?
I mean, the short answer is it's not easy to get them, but they're going to be needed. The vast investment in AI data centers and renewable power means that metals and materials demand is set to soar. Copper is the great example, and I know Olivia talked about this a lot as well. According to one forecast, copper demand could grow by around 70% to 50 million tonnes a year by 2050. But copper is pretty hard to come by. Existing mines might produce around 15% less copper in 2035 than they do today. So you've got an increased demand and yet a reduced supply for copper in the future. And that is obviously basic 101, where you've got, from an investing perspective, a sweet spot in terms of an investing need. Mining companies ultimately are investing billions of dollars to grow that copper supply. The major reinvestment just to stand still is a challenge for the industry. So demand rising, supply struggling, what happens in that environment? The price goes up. And again, from an investing perspective, super, super interesting. And one other thing always to remember with this, most of the world's major metals producers are listed on public markets. So we believe this area presents a really interesting long-term investment opportunity.
So Helen, you've made a compelling case for infrastructure as a long-term theme, that there are a number of sectors and industries that you can invest in to benefit from it. And that, of course, it's not just private markets, but also public markets that offer access to infrastructure. But perhaps you can also talk about some of the challenges when investing in this area that investors should also consider.
Well, there's a couple. The first is politics. Politics is really important. The regulatory environment is different in every region. So it's really important to have that local expertise and deep company knowledge. The second is interest rates. Ultimately, what we have here are companies that are valued based on the present value of future cash flows. So they're very bond-like in the way that the prices react. And if interest rates are seen to be stickier, just like with bonds, that does put pressure on their prices. So that could be a little bit tricky. If interest rates stay sticky because of inflation, then what we might see is some pressure on these prices. And that's something we need to be aware of. But I want to bring it back to basics. This is a sector which is critical to what the world needs at the moment, which is more energy. And we are in a situation where the amount of demand that is being required is greater than the supply, which we think will give us earnings growth going forward. So these are some of the benefits of investing in infrastructure, as well as some of the risks. And these are the things that investors ultimately have to consider.
Right, Helen. And that last point, it almost goes back to something you said at the outset, which is the demand for energy is growing worldwide. There's a step change in that. And therefore, these companies are seeing a step change in their earnings profile, which is what should be the most compelling item for investors to consider. Helen, this is definitely a theme that I think is going to have some persistence for some time. So I have a feeling that we're going to welcome you back at some point to hear more about what you're seeing in the public markets. Thank you for sharing this info, and thank you for doing it on The Bid.
Thank you very much, Oscar. It's been great to be here.
Thanks for listening to this episode of The Bid. Next up, we dive into the growing trend toward private markets investing and how these types of exposures can be a ballast in uncertain economic times. If you want to keep up with what's happening in the economy and the latest market trends, make sure to subscribe to The Bid wherever you get your podcasts.
This content is for informational purposes only and is not an offer or a solicitation. Reliance upon information in this material is at the sole discretion of the listener. In the UK and non-European Economic Area countries, this is authorised and regulated by the Financial Conduct Authority. In the European Economic Area, this is authorised and regulated by the Netherlands Authority for the Financial Markets. Reference to the names of each company mentioned in this communication is merely for explaining the investment strategy and should not be construed as investment advice or investment recommendation of those companies. For full disclosures, go to blackrock.com/corporate/compliance/bid-disclosures.